So we're going to continue our discussion on dividends and moving on from stock dividend journal entries. So you can see that the stock dividends have certain effect on the shareholders equity section. You can see that the common shares, the value before stock dividends were declared is $500,000 in this example, and the value after they were declared is $575,000. Retained earnings has decreased by the same amount, because if you go back to the journal entries in the previous slide, you can see that the retained earnings account decreases and the common stock account increases. So in this example, the value has increased by $75,000 in common shares, and retained earnings has decreased by the same amount. The only things that really change are the issued shares, which has gone up from 50,000 to 55,000, and hence the book value per share has decreased because of that. Book value per share is simply, as you know, total shareholders' equity divided by the number of shares. So, and that is why the book value per share decreases, because the number of shares have increased. So what are some of the benefits of stock dividends for the company? The company does not have to give out cash, so they can use that cash to invest and grow or to pay off some of their other liabilities. However, the shareholders who have been expecting dividends, cash dividends, would maybe disappointed a bit, because they've been expecting cash dividends and traditionally they've received cash. But there are certain benefits for the shareholders as well, and that includes the fact that now they have more shares, so they can potentially get more dividends in the future, and they can also sell those shares to get a gain. Another form of stock dividends is stock splits. Stock splits are one of those transactions that usually have no journal entries to correspond to. Basically what happens is, when the share price of a certain stock has increased a lot, and the company directors feel that it is now not affordable to purchase by a lot of investors, then they may split the stock in half or in thirds. So what happens is, usually you have a stock split of 2 for 1, 3 for 1, 4 for 1, or so on, where for every share that you owned, you would now have either 2, 3, or 4 shares, and of course the market value of the shares decreases by the same ratio. So if you currently had 1 share, and now you have, after the stock split, have 4 shares, the value of the share price, if it was prior to the split $100, now it would be $25, because that is what happens after a split. The total value of your shares do not increase. It is simply the number of shares that have increased. So the stock split has really no effect on the shareholders equity section. You can see that the common shares are still $500,000, and retained earnings are still $300,000. It is the issued shares, the number of shares, that has increased. In this case, it has doubled, and so the book value per share has decreased. In this case, it has basically gone down to half. So the next slide actually describes some of the changes, or illustrates some of the effects on certain accounts of those 3 transactions, meaning cash dividends, stock dividends, or stock split. You can see on one side I have listed those 3 transaction types, and on the other side of the chart you have the 4 accounts that are usually affected by some of these transactions. Cash account, common shares, dollar account, which means the common share values, not the common share number, retained earnings account, and the shareholders equity account. So you can see that when you declare a cash dividend, cash account decreases, obviously, because you are now going to pay out cash. And there is no change, NC stands for no change, there's no change on the value of common shares account. However, retained earnings and shareholders equity account also decreases. So you can see the effects are illustrated pretty clearly in this slide. and you can also look at the stock dividend effects and the stock split effects. The next slide talks about retained earnings. Last presentation, I did explain what retained earnings are in detail, but formally, this is just a definition so you understand, and a calculation or formula where you can use to perhaps check if retained earnings are calculated accurately when you're doing questions for homework or tests. So retained earnings is a cumulative net income less net losses that is retained in the business, which basically means that is not distributed to shareholders. So retained earnings opening balance, which means retained earnings from the previous year, plus minus net income or loss. You would obviously increase this by net income or decrease it by net loss, and then you subtract the dividends that you have declared, and then you have your retained earnings ending balance. So it's extremely clear from this slide that this formula can be used to come up with retained earnings for the ending balance if you have all the others numbers given to you, or you can simply check if the retained earnings that you have calculated through different ways is accurate or not. Sometimes retained earnings are restricted in the sense that the directors restrict them, or the shareholders have restricted them to not give out cash dividends because of certain things. So restrictions can be legal, contractual, or voluntary. They can be legal in the sense that if they are, perhaps the first set of common shareholders, they may have restricted the way retained earnings have to be distributed. They can be contractual from banks, for example. Banks can say that you cannot give out dividends unless and until you have this much amount of retained earnings, which means that they can pay the loans prior to the dividends. And they can be voluntary by the directors of the corporation if they feel that that's what they want to do. So retained earnings is a concept which is quite specific to corporations, and you now should have a good understanding of a lot of these accounts, including retained earnings. And as you learn more about accounting, you will learn that there's much more to do with retained earnings, not just simply this formula and stuff like that. So we will stop it here, and we'll continue with the corporation's income statement in the next presentation. So thank you very much for listening.